Let's go to our first guest now. Hardick Bora is now with us. Hardick, let's start with the market perspective first. What do you make of the markets going into this particular month or the next financial year? How would you look at markets, in the current environment?
Thank you, Ajay, for having me. Well, from markets perspective, we look at things from a fair value approach. So we try to map where the Nifty is compared to its own fair value. And we've been doing this for some time now, more than 5 years now. And we have done a historical check. Compared to that, markets are looking relatively more attractive. Their premium at which they are trading are about maybe single digit premium, about 4 to 6% premium to their fair value as per our internal estimates. Historically, we have seen that if investors participated at this level, invested in a staggered manner and held on to their investments for about 5 years, the probability of generating inflation beating returns historically have been higher. So from that perspective, we are finding the markets attractive from a long-term investing perspective. The trick is to mitigate any short-term volatility by time invested in the market and investing in through a disciplined manner.
So how would you look at, discipline investing? Would you think that level markets have come to that level that a substantial amount of, money can be moved from the fixed income to this, or fixed income rates also at 8-9% are looking attractive?
Yes, when I said discipline, that's the right word actually you picked up. The way we recommend investors to participate, no matter what is the market level, is through a staggered way. If the markets are mouth-wateringly attractive, we recommend that participate in a 2 to 3 month staggered investment. In a situation where market seems to be fair, we recommend investing in a 6 month staggered approach. If you do this in a disciplined manner, you would be generating returns that are ahead of FD as well as inflation returns historically. That's what has been the case. I'm talking from a perspective from the history at which we have observed markets, and whenever you participate at this level, it was in your favor as an investor. So I think, yes, FD returns have been the returns that are being offered are much higher than what we have seen in the recent past of 2 years. And to that extent, any investor who has a relatively shorter investment horizon of, let's say, 2 years or somewhere around that time, 2 to 3 years, definitely FDs make a lot of sense. But for investors which are trying to not only beat inflation but generate wealth at a higher rate, it makes sense to continue to participate in equity. If you have stayed away, I think this is the time where you should participate and not avoid this relative time correction that we have seen for the last 12 to 15 months in the equity markets.
Right. So when we talk about sectors, you think that within markets, a lot of sectors have started to look attractive because we've seen selling happening where there is a fear of slowdown. We've seen selling happening, in select sort of groups and high beta names. However, defensive are also not done particularly well. So how would you look at the markets?
Yes, I think wherever there is a concern on business growth, even if the business earnings haven't necessarily taken a weaker turn in the last financial year, the stock prices have for sure seen some correction in those sectors. So when we talk about sectors like, let's say, IT or certain consumer discretionary names, maybe the earnings have held up, but the expectation that probably the business environment might be challenging, the valuation of some of these sectors have seen some correction in the recent past, and IT for almost 12 months now. We believe that the pace at which our economy is growing, we are supposed to be the ninth fastest growing economy over the next 5 years, despite being the sixth largest by size as per IMF data that was published in October 2022. With this kind of strong growth, I think all sectors are very attractive from the long term. Currently, of course, we are more bullish on financials and consumer discretionary sectors, which includes, of course, even telecom is a consumer play, actually. So we are bullish on these sectors because we feel that there is still a lot of demand that is being seen on the private consumption side. Historically, when we compare the pace at which private consumption has picked up in our country and the gap that we have to cover as far as comparing ourselves with the top 10 nations of the world are concerned, I think keeping that gap in mind, consumer discretionary and consumption theme in India is a very long-term story, and we are bullish on that. We think the valuations are also now reasonable. Financials, of course, for the economy to grow, you need a strong financial system that is backing it. We feel that balance sheets have become much stronger as the companies have emerged from the pandemic. The valuations, of course, are a different matter, but I think the business momentum is very good. we are also bullish on the industrial play. So if India manufactures more for the world, there is a lot of investment that will go as far as the industrial space is concerned. So setting up of factories and the infrastructure around it, that will help in India becoming a manufacturing hub for the world. So we are bullish on that space as well. What we are not bullish on, or rather, you can say we are equal weight or underweight. We are equal weight IT at this point of time. We had been underweight for a long time, but we are equal weight only because we are also trying to wait and watch by when will this concern on the growth slowdown really dissipate. We feel that probably as far as earnings are concerned, maybe the bottom might be near, but we still want to wait and watch on that side. So we are not underweight anymore on IT, but we are equal weight. We are underweight on the materials theme. So commodities where the market environment is not in the favor of manufacturers today. The demand supply situation might not be in their favor. So whether it be metals, steel companies, commodities, or even cement for that matter, we are trying to still see whether we are going to witness maybe a weaker economic environment for next 12 months and then take a call after that. So these are the sectors we are broadly bullish on. I think the consumption theme and the themes related to India becoming a manufacturing hub for the world is what keeps us excited at Union MF, and we are trying to identify names and opportunities in this space.
Got it, Hardik. Thank you so much for taking out time for us. Good to get perspective.